All right, folks. Thanks for joining this webinar from Option Hotline. I'm Keith Harwood. For those of you that don't know me, I'll do a little bit more of an introduction in a moment. But we've got an exciting topic today. We're going to be talking about something that I like to call the home run swing. And this is just a way to use options to supercharge your swing trade. So it really helps to add really big leverage to some of these trades. And I'm going to talk through how I find those setups and then implement them as we go through this. So first and foremost, let's talk about the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. My lawyers basically make me show this at the beginning of every presentation. So if you guys don't mind taking a moment to read through this, and then we will get going into the exciting stuff. All right. Hopefully that was long enough for all of you to get a sense of what's going on there on the legal side of things. And there's me. So this is your introduction to me. I'm Keith Harwood. I started my career in the option pits of the SIBO. So graduated from the University of Notre Dame in 2005 with a major in theoretical mathematics and economics. So more of an analytical approach to everything. And as markets basically moved from a lot of open outcry to a lot of electronic trading, it became that much more important to be very numbers focused. So that was really my strong suit, was being in there with a very good statistical approach to everything. But after we got through the subprime crisis, things really started to change drastically in the markets. Everything that I had said had started to move from open outcry really focused on the electronic trade. And if you actually go to the SIBO floor today, you'll see very few people down there anymore for this reason. Most of this stuff is done by people on computers up in an office somewhere. I started that process for the firm I was working for as a market maker. I was one of the first traders they had move off floor, was trading numbers of exchanges, over 100 equity options classes, basically just trading everything I could, but realized that the markets were almost becoming too efficient for the market maker to make good money in the model that we had. So I decided to move on, get my MBA from the University of Chicago, focusing on econometrics and statistics, entrepreneurship and analytic finance. So again, taking the number stuff in. At the same time, I was trading fixed income options. So I got some exposure to a completely new market. And then I traded options on gold and silver through the subprime crisis, or not through the subprime crisis, sorry, through quantitative easing, because that was clearly where the excitement was. Once I finished my MBA, I went and worked for a hedge fund, focused on commodities. And, basically what I did from that point was realize the power of technical trends. So when we're trading in a CTA, basically a commodities-focused hedge fund, there's a huge reliance on the technicals because technicals trade every day. The fundamental inputs come, monthly if it's a crop report. When you're talking about an equity, it's quarterly. You get the quarterly earnings report. So when I'm trading equity options, if I have 500 stocks to choose from, I can just move from one stock to another. If I'm trading commodities, I have to trade the technicals every day. So that really allowed me to hone in on my technical skills while teaching them more about options. And we learned this great little combination of how to take a directional bias and allow me to implement sort of the trading setup and say, wow, there's really big power in options if you have a directional bias with a target price and a really strong knowledge of how all of the options work together. So it's really using all of the tools at our disposal. So I took that and said, you know what? Instead of kind of forcing myself to only trade these few commodities, why don't I go back to the equity option space now and try to help others that are struggling with their trading for one reason or another, or looking to really leverage up their trading? And that's why I started Trade Academy in 2017. And that's why I started up this work with Option Hotline this year when they started. It's really to help others learn more about how to use some of the tools that we in the industry, we on Wall Street, we in the pits, we in the hedge funds use to really find leverage when the trade is there. And so today I'm really going to focus on this concept that I mentioned, which is swing trading with options, and taking the power of options and using that tool to create explosive return profiles in swing trades. So to get you to where you understand what we're looking at here and what I'm trying to walk you through is, I'm just going to walk you through the setup, what a swing trade is, this simple technical setup. It's one of the easiest technical setups to recognize, and it's great in terms of trading it as well. So that's a really nice combination. If it's easy to recognize on the technical setup, then I think anybody can really implement this kind of strategy. But I go kind of a step beyond that because I want to talk to you guys about the price targets and everything else using that statistical background that I have and how to actually make the options work for you. And then why that volatility matters, how I incorporate that volatility. And then at the very end, I'm going to talk you guys through a special offer. So make sure you stay to the end because there's a lot of information here and I know you're going to get some really good value out of it. So first things first, we're just going to talk what's a swing trade. So we go to Investopedia. It's, they've got a bunch of random definitions on all sorts of investing things, and this is one that I actually like. You can read it here. Basically, you're talking about capturing gains in a stock within overnight hold or up to several weeks. So what am I looking for here? When I'm looking for a swing trade, I'm looking for something that has hit a technical inflection point, starting to move. Maybe somebody's buying and I just want to jump on that trend for a short period of time. My average trade on these swing trades is 2 to 3 weeks. So I'm not investing in this stuff like Warren Buffett. I'm not a high frequency trader or trying to market make this stuff like I did when I first got in the pit. There's not this great efficiency in those sort of things. I leave the intraday short-term small movement trading to the high frequency guys and the scalpers. I leave the investing world to those guys with billions of dollars because they need to invest in order to get any sort of efficiency out of the money that they've got. They're too big to swing trade. I and most of us in the retail world are the right size to swing trade because we can get in, can hold for a few days, and then we can get out and move to the next trade. We are dating our stocks. We are not marrying our stocks. So we go around and we look for the opportunity. And the nice thing that we always have in swing trading is that we don't have to make a trade. The market maker has to make a trade. A guy comes into the pit and says, I want to buy these calls. As a market maker, I had to tell him, okay, here's the price I'm willing to sell them at. And I may not have wanted to sell them, but I have to give them a price. When we in the swing trading world see an opportunity, we pounce. And when we don't see an opportunity, we stay on the sidelines. So that's what we're working through here, is trying to find these opportunities so that we can pounce on the opportunity that presents itself instead of forcing ourselves into trades that really don't have a fundamental value or a technical value or anything else going on. Because remember, these technicals happen every day. The fundamentals happen every quarter. So I'm looking for that technical signal and getting myself into these swing trades so that I can make a quick buck and then move to the next one. And so this is the simple technical setup I want to talk about today. So there are a number of different drawings, versions of various technical setups. And what we're really doing when we draw these technical setups is trying to put a visual representation to something important happening in the market. So every stock has a supply and every stock has a demand level, much like a commodity or anything else. Well, what's that supply? That supply is the willing sellers of stock at a certain price level. The demand is the willing buyers of stock at a certain price level. And then everything in between is kind of that chop. Well, when you have a rectangle, you have a very clearly defined supply, which we call resistance, and demand, which we call support. So let's just assume, for example, that this is a stock that's been going up. I mean, we can name, I'm sure we can name dozens of stocks right now that have been going up overall. Well, what happens a lot of times is when these stocks get to a certain level, some supply comes to market. Somebody that's in from a lot lower price has decided he's made enough money and he wants to move on, or she's made enough money and she wants to move on. And that person starts to sell out their shares. So let's make this a simple example, and we'll try to put some numbers behind it on my theoretical stock. I have a stock that's gone from $80 up to $100. And somebody up there is willing to sell the stock at $102. And somebody out there actually thinks that this stock's worth close to $120. So they're paying $98. Well, what happens in between is we just chop. There's a big offer at 102. There's a big bid at 98. And everything in between is just these high frequency traders and a little bit of randomness going on, where somebody decides one day to pay 99 because it's close enough to 98. And sometimes somebody pays 101 because they're just not sure if it's going to go up any further or down further, but it seems like it's an okay investment level here for them. So what we do is we just consolidate. There's distribution of the equity. The seller is giving up his shares, taking his money, while somebody else that sees more upside is getting involved. And then at some point, either the buyer or the seller wins out. Either that supply runs out or that demand runs out. And when that supply runs out and the demand gets more aggressive, the stock explodes to the upside, because now instead of that 102 offer there, we're looking for the next seller. And the next seller may not be until that theoretical 110 or 115 or $120 level that I talked about before. And that's what creates this explosive potential. So we have this initial support below, initial resistance above, and a stock that's starting to run. That's a great setup for me, because that's something that I can leverage, because I know that the stock has buyers. Anybody that was selling with this guy at 102 to try to establish a short position, thinking he could buy it when we got lower, he's now getting stopped out of his position because he's losing money. And everybody that's making money is sitting back, relaxed, and enjoying the ride. Well, now I want to jump on and enjoy that ride with them. Now, on the way down, it's the same thing. They always say never catch a falling knife. Well, this is the falling knife scenario. The stock just continues to go lower. And then finally, somebody that's short or somebody that's not long says, you know what, this is a good value area. I'm going to start buying. Or somebody that's short says, you know, I'm going to start covering my position. Well, eventually, the guy that wants to buy there runs out of inventory to buy, and then the market continues to go lower and everybody's stopping out again. One of the great things about this sort of setup is that the market tends to go higher. I mean, if you look at it for the last, century, stocks tend to go up. Yes, there are periods where they go down. We had the subprime crisis. Clearly, the market went down, but we've fully recovered that entire loss over time. It takes time, but money flows into the markets. So when you have a scenario where this stock that you're in or I'm in or somebody else is in continues to go down while other stocks are going up, that is the most frustrating thing in the world, and that's what creates the capitulation sign, the press down to new lows. Those are the stocks that are just not as good as the rest of the market. And they're just not that good. And so they oftentimes get this major, major washout when somebody out there just says, I'm tired of it, I'm done, I'm selling. And I can take advantage of that. So when I see this setup, I'm buying when we get above the resistance in the uptrend, or I'm selling below support. But as soon as I do that, I have a complete trade structure that I need to put on before I actually enter that long. And so the first thing I always talk about is the risk. Number one, there's the stop loss. If I'm focused on the profit before I'm focused on the risk, I will blow out my account. Because you don't lose money, or you don't blow out an account from profiting too little. You blow out an account from risking too much. So the very first thing I do is I set my stop loss. I go through the market and I say, okay, what price am I out of this trade because I lost too much money? And so if I'm looking at this on the bullish thesis, so we'll talk about it more on the bullish side here for the moment, my initial stop in this is that initial support level. So if I'm in a rectangle here, this is the support, this is the resistance, 98 was support, 102 was resistance. If I'm in at 102 and we get below 98, it tells me that that buyer is gone. So the seller was gone, and now the buyer is gone, and I have no idea where the stock's going to go next. Because remember, I'm not a fundamentalist on this. I'm just trading off the technicals. So if we've blown through that level we could not breach before because there was a big buyer, it tells me that now the selling pressure is in charge, and this could turn into a falling knife. So I'm out. So that's how I set my initial stop. It's on that support level. On the contrary, for the bear trend, I'd be setting my stop, my out, if we get above the prior resistance level. That's it. That's how I set my risk. Now, on the profit side, it's a little tougher, because when we're looking at this setup again, there's no obvious stopping point on a breakout to the upside. There's no obvious stopping point on a falling knife. So how do I set that level? Well, this is where I bring in that mathematics background and that statistical background, and I start looking at standard deviations. So for those of you that are unfamiliar with what we're looking at here, this is a normal distribution. It's a bell curve. The expectation is nothing. This is one standard deviation. This is one standard deviation down. So on a day-to-day basis, if we assume that a stock follows a normal distribution, which it's not really, because we get these crazy moves much more often than a normal distribution, but it's close enough. for what we're talking about here in the meat of a move. Now, if I'm looking for a normal distribution, I would say that a stock will move up or down less than a standard deviation 68.2% of the time. So we'll call it 2/3 of the time, a stock's going to move within one standard deviation of the current value. And roughly 95% of the time, it's going to move within 2 standard deviations of its current move. So we can calculate these standard deviations using the volatility metrics of the market and everything else. I'm not going to really get into too much about the actual calculation for this point, but what I want to tell you is that when I look at a profit target, I do it based upon the standard deviations. So that's that expected daily movement. If a stock normally moves $1 a day, up or down, that's a 1 standard deviation move if that's the 68% level for me. So if I have a 1 standard deviation move is $1 in a day, then if that stock moves $2 in a day, I start to look at a possible point to take some profits. And if my time horizon is a month, then to calculate my movement, I basically take the square root of the number of days for that time horizon. So let's say 25 trading days. The square root of 25 is 5. So a 1 standard deviation move over that 25 days would be $5. And a reminder here, if you have any questions, feel free to put them in the chat or in the Q&A. I will make sure to answer them at the end or in between if necessary. But what I'm looking at here is that standard deviation calculation. So I go through the statistics and I calculate a standard deviation and I calculate a daily 2 standard deviation move. And that sets my initial framework for where to take some profits. And I don't set that in stone. That is important that the risk is set in stone, but not the reward. There are a lot of ways for me to take profits once these levels are breached. I can use a trailing stop. For those of you that know what a trailing stop is, you basically raise the stop level as it's going your way. Or I can look to exit, or I can roll a position if I'm in options. There are a lot of different ways for me to move my position around. But this is where I am initially looking for my target. And the reason I never say that a standard deviation move over my time horizon is the point of exit is that then my average return will be less than that. Because sometimes a stock only goes a half a standard deviation in my favor. That's a smaller win. So sometimes I have to have that stock that goes 1.5 or 2 or 3 standard deviations in my favor to get that even bigger win. And frankly, just because it's a standard deviation move doesn't mean it's going to stop there. Remember this chart here. This is the chart of the normal distribution. When you see stocks that are down 8, 9, 10 standard deviations in a day, and this happens, it's basically a violation of the normal distribution because it should effectively never happen. February 6th this year for the entire market should never happen. Too big of a move based upon the normal distribution. Stocks that get taken over should never happen based upon this distribution. There's gap risk. There's news. There are events that can happen that cause bigger moves than the normal distribution. And so we have to keep that in mind when I'm setting my initial profit targets, that these things can move much further than the statistics say. But most importantly, I set my stop loss so that I exit and get rid of that risk when it's bad. It's a heck of a lot easier to ride a winner than it is to ride a loser. Riding a loser every day, you're going to go bald. You're going to want to kill yourself on some days. It's not a good feeling. Don't kill yourself, please. Focus on the winners, get out of the losers, and live a happier life. And now the real key to this, and this is great. This is why I use options. There's a number of reasons behind it, but not the least of which was the fact that I grew up in the option pits. But if I have a $100 stock with a $120 price target over a month, and my stop loss is if the stock goes below $90, then really, if I buy 100 shares, I'm risking $1,000 to potentially make up to $2,000. It's a pretty easy linear graph here, right? It's just the stock P&L. If the stock sits at $100, I break even. If it goes up by $20, I make $2,000. And if it goes down to 90, I lose my $1,000. That's my risk tolerance. So I've set my stop loss, $90. I've set my profit target, $120. I do my total risk and say, okay, well, I'm willing to lose $1,000, so I can go buy 100 shares. So in my case, I've set my whole parameter for my trade. My initial profit target over the course of the whole thing is $120, about a 20% move. It's a pretty big move in a month for a lot of stocks, but it's not that big for others. That's the nice thing about the stock market is various stocks have much bigger or smaller potential moves, and those are the ones that get really exciting. But options help to, offset that potential by pricing for those moves. So let's say, for example, that I'm looking at the same stock, and now, I have these calls that expire in a month. It's the 100 strike. Gives me the right but not the obligation to buy stock for $100 at any point between now and expiration. Well, if that stock goes to $120, each of these calls is now worth $20. So I made $15 per call. That's a $3,000 profit. If the stock drops, I lose my initial premium, $5 times 2 times the multiplier of 100, so that's $1,000. So this is starting to give you guys a little bit of a sense of the trade-off, right? I have this option that gives me the option to buy more shares than I could have otherwise afforded. I could buy 100 shares, use up $10,000 of capital, risking $1,000, or I can buy 2 calls, using up $1,000 of capital and giving me the right to own 200 shares. But I have to see the price increase in order to make money. And that's what we're seeing here. Which one would I rather have? 100 shares or 2 calls that represent 200 shares total, but need to see a bigger rally to be worth more, right? So if we get to $110, those calls are each worth $10. I've made a profit of $500 per call, $1,000 total, the exact same return as a stock position. Anything under 110, I make less. But if I hit my price target of 120, I make 50% more. Instead of making $2,000, I make $3,000. And let's also talk about the downside. So I said that I was going to get out of the stock if it goes to 90, but February 6th happens. Or this is an individual equity. I might walk in tomorrow and find out that the CEO was smoking weed on a podcast. Or I might find out that the SEC is investigating and the stock went way through my stop level. I can't trade out of it if it just gaps down. I'm not out at 90, maybe I'm out at 80. So I thought I was risking $1,000, and guess what? I lost $2,000. And I have to honor my stop because it's an absolute stop. If we go below $90, I want to be out. So if we're at 80, I still want to be out. It's really painful to sit there on that falling knife and say, man, my open P&L on this is negative $2,000, and it's only getting worse. So I have to get out. I have to honor my stop. I have to honor my risk parameters. So I exit the trade with a bigger loss than I thought was possible, and my account is down more than I expected. That doesn't feel good. Now, if all the same stuff happens and I've just got those 2 calls, the absolute most I can lose is the premium I put in. So I lose $1,000. Really sucks that something negative came out, bad news, bad fundamental inputs came out and made this stock liquidate. But I never have to worry about this stock liquidating beyond my stop point and me not being able to get out. So I get to find risk on the downside. I get leverage on the upside. So you might be telling yourself, wow, I want to buy calls every time I have a swing trade. And I want to do it in size. I'm going to make more money this way. You know what? I'm going to just use the account. Well, that's wrong. And I'm going to remind you guys again why I only do 2 calls, not the full account. So if I had $10,000 worth of stock, why shouldn't I buy $10,000 worth of calls? This is a mistake I see people make all the time. It is a deadly mistake to make for your account. Because instead of risking the $1,000 that I was willing to risk, now I'm risking $10,000 if I buy 20 calls. So even though I thought to myself, wow, why should I have $9,000 of cash after I buy my calls? It's because of this. Sure, if I'm right and we go to $120, I make $30,000. That's great on a $10,000 bet. But if the market sits and we're still at $100 in a month and these calls are worth nothing, I've lost it all. This is risk management 101 in this sort of setup. If I'm buying an out of the money call, willing to risk everything that I've paid on that call, I can only buy as much as I'm willing to risk. So if I'm willing to risk $1,000, I only buy $1,000 worth of calls. not $10,000. And there's a reminder. If that stock keeps going below 90 and before I was able to get out, I still only lose $1,000 in this case. I lose $1,500 here, and this is where I lose $10,000. If you take nothing else away from this, just remind yourself never to put all of your premium, all of your capital into out of the money options. It's a quick recipe for disaster. I mean, these are at the money options, and they could be a quick recipe for disaster. So yes, the option market can give leverage, but it can also give people a false sense of defined risk. Risk management 101, only risk what you can lose. Now that I reminded you about that, let's talk about why volatility matters, because volatility is crucial to when I want to buy these options. So I've talked to you now about why I like being in options and how I'm trying to make sure that I size those options for the risk side. And let's talk about why I'm actually going to use options instead of stock now. Because there are times where a stock position is actually a lot better than an options position in spite of those characteristics of defined risk and leverage. If everybody in the world wants defined risk and leverage, they drive up the price of options. It makes them no longer beneficial, okay? We no longer get the leverage. I no longer get to make that much money on a move. So let's talk about this little bit of the implied volatility mean reversion here. So if implied volatility is normally around 36%, which means that I expect that stock to move 36% over the course of a year, or a little bit over 2%, about 2.25% on a single trading day, then these are the values of various options. I've got a menu in front of me every time I look up the options. When I see the stock, I've got the stock. But when I look at the options, there's a menu. There's the 94 calls. There's the 100 calls. There's the 106 calls. There's the 120 calls. There might be the 150 calls. Which one do I want to buy to make my swing trade work? Well, if I think implied volatility is too low at 30%, then what am I getting the best discount on? It's the 106 calls. They're 28% cheaper than they would be if they were at 36%. So if the stock's trading at 36%, if the options are implying a 36% implied volatility, that expected move of 2.25% per day, and I think that's fair value, then I'm getting a fair value on my pricing. If the market is saying 30%, well, my real discount comes on these 106s, 28% cheaper than they would be if they were where I thought they should be valued. Why? Because the 94s have what we call intrinsic value. If the stock stays at $100, this is still worth $6. It is $6 in the money. So I can only lose the extrinsic value, that $1.75 of extra premium. So this is where people also make huge mistakes in swing trading with options. So you say, oh my God, I just want that defined risk and I want that leverage and I'm going to hold this for a couple of weeks and it's not that big of a deal. The stock's going to move and I'm not going to look at implied volatility. And guess what? When that happens and implied volatility is here at 42% or even much, much higher, I'm making a huge mistake. I'm paying 29% over fair value because I'm paying $3.50 for something that I think should actually be worth $2.73. Or the big extreme is when I see something that I think should be up at 42 vol and it's down to 30. So instead of being worth $3.50, it's under 2. So for my $1,000, I can buy less than 3 here, or I can buy 5 here. That's buy 3, get 2 for free. That's the clearance market. That's the clearance sale. That is me walking in to Nordstrom, going over to the clearance rack and finding something that I wanted desperately, and it just happens to be on sale 60% off of what I think it should be for. That is an awesome opportunity. So that's what I look for. I look for these awesome opportunities where the stock is or the options are way underpriced given the potential for movement. Because I'm looking for these things that have potential for movement. That's my technical signal. And then my option signal is nobody thinks that it's going to move. That's great. Nobody thinks it's going to move. I do. I have an edge. Let's compare the risk reward in that low implied volatility environment to the high implied volatility environment at expiration, because this, I think, helps illustrate where that leverage exists. When implied volatility is cheap, 30%, the 106 calls have this massive return profile. I can risk $1,000 and potentially make $6,000 if we hit my price target. That is a home run. Even the 100 calls, I'm risking $1,000 for the potential to make almost $4,000. That is a home run. The 94 calls look a heck of a lot like stock. Okay, that's fine. It's just like stock. I can handle that. I'm not getting any leverage, but at least I had some defined risk. Now, when I look at this in a 42% vol regime, that high vol regime I was talking about, my 106 calls, yeah, they outperform stock, but I'm only making $3,000 if I get it right. So instead of $6,000, $3,000. That is a huge difference. Less than half of the potential profit just by having implied volatility not priced favorably. The 100 calls basically look like stock. The 94 calls are actually worse than stock. So all of these things lead me to the point where if I don't get an edge in volatility, then I shouldn't be just buying out of the money options or at the money options or even in the money options because I'm not getting the leverage. I don't get real profit potential relative to stock. I'd be better off just buying my stock, setting my stop loss, and keeping it simple. But I would rather see this stuff explode. So when I find a setup where it's got a technical setup where the stock really hasn't been moving, it's in a rectangle, it's in this tight range, and it's breaking out, and this implied volatility is cheap, where I got to buy 5 of the 106 calls, not 3, 5, that's where I get my profit potential. And the other thing I want to remind you guys on here is that there's that trade-off, because see how much move we have to get in the 106 calls before they start to outperform stock? I've got to get to 110 before they outperform in that low implied volatility environment. Here, I've got to get to 115. So just thinking about the magnitude of move I need to outperform stock can often set me in the right frame of mind. Because one of the most painful things to do is to be bullish on a stock expecting a move and have it underperform your expected move so you actually lose money instead of making money. Because if this stock, I'm in the 106 calls and we run to 107, those calls expire worth $1. I've lost $1 on my 5 lot. I've lost $500 even though the stock rallied 7%. Same idea here. We rallied to 107. I've lost $2.50 on my 3 lot. So I lost $750 even though I was right on the direction. It's painful. So I try to improve my odds by getting cheap implied volatility. Then that big move helps offset the smaller moves and it kicks in earlier. So how do I incorporate this? You want to think about the actual implementation, right? So that's what we're here for. We're here to try to figure out how to actually do it. I find that setup with low implied volatility relative to historical. So it's that stock I think should be 36% or even 40% volatility, and right now it's trading at 30%. Well, guess what? A lot of times when we're trading in a rectangle, that drives low implied volatility. When we're not moving, people don't often buy options. They sell options, expecting us to continue not moving. But they don't necessarily move on the implied volatility, move on the options right when we trigger the technical signal. They wait until we've actually started moving. So if I can get into the options just before we're about to start moving like crazy, I get this great entry point. And so I've got these options that get cheap because we're not moving, look like they're about to get really expensive and we are about to start moving. And then I structure my trade. So I look for something that's heavy on gamma. For those of you that know options, that's, you'll may be familiar with gamma. That is the curvature of the P&L. So these are things that move quickly and become in the money quickly and they increase their delta quickly. The gamma is defined as the change in delta for a change in the stock price. So I want something that's going to pick up delta quickly so that it starts picking up P&L quickly. So I'm looking for something less than a month expiration, but close to a month expiration because vol is so low that I'm getting a little extra time for free. I start with 30 delta options. 30 delta options are out of the money. They are the low probability option for most people. People tend to avoid these options. Well, I went through, I did all this math, I did all this work, and I now find an opportunity where 30 delta options actually work better. That's great because I know that there's often a supply of 30 delta options in the market because people don't like owning them. So that's what I'm buying. I'm buying what is often the cheapest option when volatility is cheap, right when it's about to get expensive. And then I just target that 1+ standard deviation move in the direction of the breakout, given my timed expiration. I calculate it all out. I do my risk. I say, okay, I'm risking $1,000. I buy $1,000 worth of these options. I look for my reward profile, and then I manage the trade. How do I manage the trade? We'll talk about that in just a second. We're going to get into examples, but first the checklist. You guys all should have gotten this in your email. An opportunity to just download my checklist. That talks you through the way that I go through these whole trades. So how I define the risk, how I manage the trade from entry all the way to exit. Gives you a quick checklist so that you can go through and say to yourself, all right, if I'm going to trade this the way that Keith likes to trade this, I need to make sure I follow this process. That will help you walk through how these swing trades work. So if you didn't see the email, check your spam. If you did see the email and you didn't opt in for the checklist, I urge you to go do that now. If not, if you didn't see the email, you can't find it in spam, you didn't take it, go to optionhotline.com/Keith's checklist. You can register for the checklist. It'll go to your email. PDF, you can print it out, you can look at it, you can watch yourself go through these trades. And it's free, so there's nothing you have to do here other than just download it. So I urge you guys to do that. There is a benefit, I think, to knowing where the checklist is when you're going through these trades. All right? Now that we've done the checklist, I want to walk you through a few trades that had this exact setup. Okay? So MNST, Monster Beverage Corporation, was a great example of how this trade works. On June 29th, it started to break out of this box. Okay, you see this box that was forming. The June 25th high right here was 57.30. On June 29th, we went through it. So we're starting to make new ground, trading to new levels that we haven't seen recently. So we know that whoever's been selling in this box is probably done. Whoever's buying is getting more aggressive. So I start going through the process and I tell myself, okay, well, where's implied volatility relative to history? Well, over the last 3 months, forgive me, before I do that, I'm going to remind you guys or explain this chart to you guys. So this is off of a platform that I use called Sterling Vol Trader. Implied volatility is measured by this red line. So when it gets low, that tells you that people are pricing options cheap. The blue line is where the stock's been moving. So when that's higher than the red line, it means that the market is moving more than the options have implied. So historically, we've been moving more than the options are implying. We're going to move in the future. So I've got these cheap options, relatively speaking. Looks like they're pretty close to historical lows. I got cheap options. So I said, okay, it's June 29th. I went 3 weeks out. And I bought the 30 Delta call, which was the July 20th 59 call for 55 cents. And then this happened. The stock kept going. So we had a couple of days where it sat, but then it really popped. Took a couple day breather and then really popped. So on July 17th, the stock closed at $62.17 and I exited my calls for $2.74. So I actually exited earlier in the day. You can see that they were worth $3.17 just in intrinsic value by the end of the day. I got out earlier in the day than that and still made almost 400% on my entry in just 3 weeks. So that's that home run potential. If I'm risking $1,000, my profit is close to $4,000. If I'm risking $100, my profit is $400. If I just bought one call for 55 cents, my profit is $219 plus some commissions and fees. Or minus some commissions and fees. So just under $219, but without commissions and fees, $219 per contract. That's a really nice reward for taking a swing trade when a stock rallies, from 57.5 to 62. So the stock moved less than 10%, the options move 400%. Let's go through it again, just to kind of reiterate this process here, right? So we have June 11th, Endocyte, a small biotech company. For those of you that have ever traded biotechs, you know that with these small ones, they can move way up or way down. I mean, you can see this stock had the range from about $7.50 to $15 over the course of this 3 months. So of course, I like that defined risk because good Lord, I don't know if the stock's going to drop by 50% sometime in the coming weeks because it turns out that whatever was going on with it isn't actually good. So on June 11th, we traded through the high of 1486. June 12th, was the day I actually was able to enter the trade. So I kind of went out the extra day. But you can see that implied volatility is generally about as low as it gets. Realized volatility has been a little lower, but we've seen this big movement. Big movement in the past. And so I thought to myself, this could have that explosive potential like it had before. So I got these July 20th, $17 calls for 60 cents. And I was sort of right. So this is that example I was talking about where the stock actually ended up sitting. So it never went through support, never really justified an exit from a technical perspective, maybe justified an exit from a option premium perspective. The real breakout didn't really happen until basically the beginning of July. And then the stock popped all the way to 17.33 for expiration. So I was able to exit my calls for 45 cents, which is better than I would have if I held to the close. I lost money on this stock. So the stock rallied from $15 to over 17, 15% move. And I lost money because the stock just didn't move enough in my direction and fast enough in my direction. So this is what I'm talking about when I say that this is the trade-off on options. It's okay to lose money on these things when the stock doesn't move enough because the winners well offset the losers, but this is why I define the risk and I understand that risk of a stock not moving enough. I'm going to give you one more example here, and that's GoPro. So everybody's familiar with GoPro, I'm sure. It's, got those little cameras that you can record yourself, like riding a bike or surfing or doing whatever other outdoor activity you like to do, or record yourself trading if you want, I guess. And, the stock has really been down in the dumps. But it started to set up some interesting technical setups. So we had basically two rectangles at once forming here. So the recent rectangle here, and then the longer term rectangle on the outside. So the first level I was really keyed in on here was this move through the May 31st high of $5.68. And it looked like this was just getting started. At a minimum, I thought we could get to $6, but I thought there might be this chance for a nice little short squeeze to push us well through $6. So I looked at the options and said, oh my goodness, this is about as cheap as the options ever get in GoPro. Rarely do they get this cheap. And we're talking about a stock where options are often in the 60, option implied volatility is often in the 60s, and it's barely over 40. This is a huge discount. So I bought the June 22nd $6 calls for 12 cents. Now note that if we just got to that previous high, the $6-ish level, the previous resistance, this doesn't necessarily work. But if we blow through that, I get some really nice potential payout here. So what happened? Well, for the first 3 days, we really kind of took off and made this the new support level. And this was my new key resistance level. And then we broke through that just a couple of days later. So on June 12th, 8 days after I entered this, the stock was trading $6.57, and I exited my calls for a 325% profit in those 8 days. Never had to really sweat about it. Stock just had a nice big move in the course of 8 days. And that's all it takes. So the stock moves $1, so 15%, but my calls move by 300% plus. That's that home run I'm talking about that helps offset those small losses. And sometimes I lose 100% of the premium, but when I make 300%, I've paid for 3-4 bad trades. And trust me, when the odds are that these trades are going to work, maybe a little less than 50% of the time, but when you're getting multiples better returns on the winners, that makes this a good system for me. So that's why I started up the Home Run Swing Trader trading program. So I'm the portfolio manager for this trading program. It's at optionhotline.com/homerun. You've listened to the whole presentation here. I know that this is just kind of scraping the surface of all that there is in this sort of system. If you want to find out more about this program, just go to optionhotline.com/homerun. You can see the trades that I'm making using this system in real time and get a better sense of how this works and how it creates these explosive return profiles. I'll send a follow-up email and everything else. Just want you guys to now take a look at optionhotline.com/homerun to find out more about the system. Now, thanks again for participating in this webinar with me, listening to everything I had to say. If you have any questions, I'm happy to answer them right now. All right. Well, it sounds like everybody's got a lot to digest here. I know there was a lot of information. think through everything that I talked about today. If something comes up and you have questions, you can always email us at Option Hotline, or you can email me, Keith at tradeacademy.co. That's tradeacademy.co. And I'm happy to answer any questions. But I urge you to make sure that you download the trade checklist, since that's free. Check out theoptionhotline.com/home run. There's a question here of if there is a trial. We'll send a follow-up email with some more information about signing up for the home run service that will include that information for you. So you'll have that in your inbox here in the next 24 hours. For now, if you just want to get the checklist and then find out more about the home run swing trading program, I urge you to check that out now. I'll give it another minute or so for people to ask questions. It's been quite an interesting opportunities in the markets, lots of movement. The gold and oil course here. There's a question here about the gold and oil courses. The courses will be coming out for gold, oil, and the commodities here in a couple of weeks. We're going to send you guys a replay of this webinar as well. That's another reminder for you guys. So you'll all get a replay of the webinar. You'll get follow-up emails here about the home run swing program. Gold and oil. You'll find out more about that in 2 weeks on our next webinar, or we have another webinar next week about big league options. 2 weeks from now, we'll have the commodities webinar. You can find out more about all that stuff as we go through the next couple of weeks. So make sure you tune in for those. And then, as a reminder, you'll get the webinar in the replay, and I hope you all enjoyed it. Lots to digest, I know. So good luck to everybody with that, and let me know if you have any questions. All right, guys. Thanks for everybody attending. We'll leave it at that, and I look forward to hearing more from you in the future.